Hello and welcome. I'm Sarah McGregor and I'm joined by my colleague Mike Elliott. We are directors in the tax practice with Bekaert, and we want to take a few minutes to share with you a new and interesting tax savings opportunity, the Qualified Opportunity Zone Fund. Mike, introduce us to this concept.
Thanks, Sarah. The Opportunity Zones program is a new initiative that's implemented as part of the Tax Cuts and Jobs Act. And what it was meant to do is to encourage private investment in lower income areas. Now, a lot of these areas have struggled with recovering since the last recession. So Congress created this program as a way to incentivize private investment in some of these areas, which are known as Qualified Opportunity Zones. Now, there's almost 10,000 of these zones nationwide. And these zones were selected by the governors of each state, and they were approved by the U.S. Treasury.
So what is a Qualified Opportunity Zone Fund?
Well, it's simply an investment vehicle that's formed for the specific purpose of investing in business or property that's located in one of these qualified opportunity zones. The investment could either be corporate stock or it could be a partnership interest. And it comes with some very significant tax advantages.
Okay, now we get to it. Let's talk about those tax incentives.
All right, well, there's actually three main tax benefits. The first thing is that any portion of a gain that's realized by an investor from the sale of another investment can be deferred if it's reinvested in one of these qualified opportunity funds. In other words, up to 100% of the gain can be deferred. And the gain isn't taxed currently, and it can be deferred until 2026 or earlier if the qualified opportunity fund is actually sold before that. Second, assuming that the investment in the qualified opportunity fund is held long term, up to 15% of the original deferred gain can be permanently excluded. And finally, to the extent that the investment in the fund is held for at least 10 years, any gain on the sale of the investment can be exempt from federal tax.
Okay, so first, in order to qualify for these benefits, a taxpayer would need to have recently sold or have plans to sell an investment at a gain.
That's right. Now, to the extent that the proceeds from a sale are reinvested in one of these funds, the amount that's reinvested up to the amount of gain is eligible for tax benefits. The good news is that taxpayers can take up to 180 days to reinvest their proceeds into one of these funds.
So in our first example, if a taxpayer is going to sell a property for, say, $9 million and realize a gain of $6 million, they could take that $6 million and invest that into a qualified opportunity zone fund and avoid paying tax until as late as 2026.
Yes, that's right. Now, as far as we know, any gain on any sale of property qualifies as long as it's reinvested within 180 days. So that includes capital gains on the sale of stocks, partnership interests, business assets, options, hedges, pretty much anything. As long as the proceeds are invested within 180 days. Now, that's unless the IRS issues regulations that would state otherwise.
So taxpayers can reinvest into the opportunity fund, the gain portion of their proceeds, and retain the remaining amount to invest in other places. This seems like a better deal than a like-kind exchange, which also defers gain, but you have to reinvest all the proceeds.
Yes, that's true. There's really nothing else like it that I'm aware of.
Okay, you mentioned a long-term hold to get the second tax incentive. What do you mean by long-term?
Well, if they hold it at least 5 years, they can exclude 10% of the original deferred gain. If they hold it at least 7 years, they can exclude 15% of the original gain.
And that holding period is measured either as the end of 2026 or the date of a sale if it's happened sooner.
Yes, that's correct.
Okay, so in our example, we've invested this $6 million of proceeds in that deferred gain into the Opportunity Zone Fund, and now it's been held in there for 7 years. So the taxpayer is eligible to exclude up to 15% of that gain, or $900,000, from ever paying tax at all. So they would only have to pay tax at the end of 2026 on $5.1 million. What happens if the fund goes down in the meantime? Can the taxpayer claim a loss?
Well, no, they can't claim a loss because they haven't been taxed on the original gain. The good news is that they're only going to be taxed on the lesser of the fair market value or the original gain. So, in other words, they're going to be able to take into account the fact that it went down in value and offset that against the original gain.
Let's talk about that third benefit.
Okay, great. Well, the third benefit applies if the taxpayer sticks with their investment in the fund for at least 10 years. Now, at this point, the taxpayer can eliminate any gains when the investment is sold simply by electing to report the basis of the investment equal to its fair market value. So as long as they've been in it for 10 years, this is an option.
So in our example, if the value of that original $6 million investment goes up to $10 million, then that difference between the $6 million invested and paid tax on at the end of 2026 goes up to $10 million, and that $4 million of additional profits, we don't have to pay tax on that either. That's a pretty powerful incentive to motivate some private investors with some large gains that would otherwise be taxable.
No, that's right. You got to think about what Congress is trying to accomplish here. The types of investors that they're trying to attract typically have substantial gains on investments. So the idea was to hit them in their sweet spot by allowing them to defer and or reduce the tax that they would otherwise pay by reinvesting the gain in this program. So first, the deferral allows them to reinvest their entire gain pre-tax. Second, it allows them to reduce the gain that will be taxed. And third, they can earn a tax-free return on the amount reinvested if they're willing to hold it at least 10 years. Finally, it achieves Congress's goal of giving an economic boost to these lower income areas.
Great. Thank you, Mike, for walking us through the tax incentives available to those investing in qualified opportunity zone funds. If you have realized a gain or anticipate generating a gain before the end of the year, please reach out to your Cherry Bekaert tax advisor or to Mike or myself. We look forward to talking with you more specifically about how this opportunity can be of a benefit to you.